Welcome to class, everyone. Let's jump right in. Today, we're unpacking a really fascinating explainer on the actual rules of the accounting game. We're going to be exploring everything from the strict regulatory frameworks that dictate corporate reporting all the way to the psychological and behavioral theories that actually drive the financial decisions made by CEOs. Whether you're an investor, a student, or a future executive, this masterclass is designed to help you decode the language of business. Okay, here's our syllabus for today. First up, the rules of accounting. Then we'll meet the regulators. After that, we're tackling the conceptual framework, followed by some accounting theories. And stick around because we're wrapping up with a pop quiz. All right, part one, the rules of accounting. To really grasp financial reporting, you've got to look at it like a layered system, built on four main pillars. First, you've got the Corporations Act 2001. That's the overarching law dictating exactly who has to report. Then, the Australian accounting standards step in to tell those companies how to do it. Now, if those standards are ever completely silent on an issue, that's where the conceptual framework swoops in to guide interpretation. And finally, if a company is listed on the stock exchange, they've got a whole extra layer of compliance with the ASX listing rules to deal with. Now, this is super interesting. The Corporations Act actually legally defines what makes a proprietary company small. You don't just get to call yourself small because you feel like it. You literally have to stay under at least two of these three specific thresholds. Less than $50 million in revenue, less than $25 million in gross assets, and fewer than 100 employees. If you cross two of those lines, bam, you are legally a large company. And that means you're required by law to lodge fully audited financial statements. No way around it. So once you've nailed down your size, you've got to figure out your reporting tier. And this is a pretty stark contrast. Tier 1 carries a massive burden. It requires companies to track and publicly disclose absolutely everything in exhausting detail. Tier 2, on the other hand, still demands that exact same rigorous math for recognition and measurement, but it cuts you a bit of slack with simplified, less exhaustive disclosure. But how do you actually end up stuck in Tier 1? Well, it all boils down to this one crucial concept: public accountability. If your company is trading debt or equity in a public market, or if you're holding assets in a fiduciary capacity for outsiders, basically, if you're trusted to manage other people's money, think banks, insurers, or fund managers, you have public accountability, and that automatically pushes you straight into the deep end, right into the strict, heavy disclosure world of Tier 1 reporting. Moving right along to part 2, meet the regulators. You really can't play the game if you don't know the referees, and these different watchdogs absolutely do not operate in a vacuum. They share an entire ecosystem. You've got standard setters like the AASB making the rules, overseen by the FRC. Then, enforcers like ASIC step in to make sure companies are actually complying with the Corporations Act. Meanwhile, you have APRA acting as the prudential regulator, which just means they're proactively monitoring financial health to stop banks and insurers from completely collapsing. It's like a giant puzzle where they all work together to bump up reporting quality and protect the stakeholders. All right, part 3, the conceptual framework.
Okay, it is absolutely crucial to remember one thing here. The conceptual framework is not an accounting standard. It doesn't override any specific hard and fast rule. Instead, think of it as providing a user-focused objective. It's this coherent set of principles designed to basically help the standard setters write good rules in the first place, and to help investors and lenders make sense of financial statements so they can make smart decisions about where to put their resources.
Look at it this way. If you're an investor, the data you're relying on must have what we call fundamental characteristics. It has to be relevant, and it must faithfully represent reality, meaning no material errors, no bias. Once you've got that solid baseline down, these enhancing characteristics, things like comparability and timeliness, they make that data even better for your decision-making. Though as future executives, you always kind of have to make sure the benefit of providing all this info actually outweighs the sheer cost of producing it, right? And now we get to the literal building blocks of every single financial statement: assets, liabilities, equity, income, and expenses. Literally every number you see on a balance sheet or income statement fits squarely into one of these definitions. And what's really important is that all of this is fundamentally underpinned by the going concern assumption. That's the core belief that the business is going to continue operating indefinitely into the foreseeable future. That assumption is exactly what justifies using things like historical cost accounting and depreciation. But here's the catch, and it's a big one. You can't just slap a number onto a balance sheet because you feel like it. An element only earns recognition on those statements if it strictly passes a two-part test. First, It has to be probable that future economic benefits will flow to or from the entity. And second, the item must be able to be measured reliably. If it fails even one of those, nope, it does not get recognized. Period. Let's pivot to part 4, Accounting Theories Explained. Welcome to the second half of our masterclass, folks. This is where things get really fascinating, because we're looking at human behavior. To understand this in finance, we have to look at a massive divide in accounting academia. On one side, we have normative theorists. They love to prescribe how the world ought to be. They tell us what should be done. That conceptual framework we just talked about? Perfect example of a normative theory. But on the flip side, positive theorists, they don't judge. They simply observe, describe, and predict how wealth-maximizing humans actually behave out there in the real world when dealing with money. And that perfectly sets up positive accounting theory, or PAT. This is deeply grounded in agency theory. See, because the owners of a company delegate power to managers, a disconnect happens. Agency costs pop up, meaning the owners literally have to spend money auditing and monitoring the manager's behavior just to make sure they aren't acting entirely in their own self-interest. PAT fundamentally assumes that individuals, in this case corporate managers, are basically always going to act to maximize their own wealth. So consider this table your absolute cheat sheet for human behavior in corporate finance. Under PAT, we've got 3 main hypotheses. Think about it. If a CEO's bonus is tied to this year's profit, they are naturally going to choose accounting methods that boost short-term income. Makes sense, right? Similarly, if they're inching close to breaching a debt covenant, they will magically find ways to increase reported profits to keep the bank happy. But under the political cost hypothesis, if a massive company is trying to dodge regulatory scrutiny or, say, public backlash over price gouging, they'll actually choose methods that decrease their reported profits just to fly under the radar. Now, while Pat focuses on the managers cooking up the numbers, the efficient market hypothesis, or EMH, looks at the investors on the other end absorbing them. EMH essentially questions exactly how fast the stock market digests all this financial data. It ranges from the weak form, where prices only reflect past historical data, all the way to the strong form, which claims that stock prices instantly reflect absolutely everything. We're talking all public info plus private, secret, insider information. Wild, right? All right, part 5. Time for a pop quiz. Okay, put your textbooks away, clear your desks. It's time to apply what we've learned today. Here's your first scenario. Kestrel Furnishings is a proprietary company. For the year, they've got $62 million in consolidated revenue, $21 million in gross assets, and 140 employees. So, based on those rules we covered earlier, are they legally considered a small or a large proprietary company? Take a second. Got your answer? Okay, think back to our thresholds. To be small, you have to stay under 2 of the 3 limits. Well, Kestrel's revenue of $62 million, that is over the $50 million limit, so they fail there. There are 140 employees. That's over the 100 limit. Failed again. Because Kestrel only met the asset criteria, they fail the 2 out of 3 test. And the result? Kestrel is legally classified as a large proprietary company, meaning they've absolutely got to prepare an audited financial report. Let's try one more, just to make sure this is sticking. Marlin Traders gets slapped with a $40,000 lawsuit. However, their legal counsel advises that losing the case is possible but not probable, and the actual final amount can't even be reliably estimated yet. So, put yourself in the shoes of a decision maker. Do you recognize a $40,000 liability on the balance sheet today? And the answer is a hard no. Remember those really strict rules from the conceptual framework for recognizing an element? You need both probability and reliable measurement. Because losing this case is only possible, not probable, and they can't reliably measure the cost, Marlin Traders does not recognize this on the statements. It's simply a contingent liability, which gets relegated straight to the disclosure notes. This really just goes to show that rigorous professional judgment is constantly required in accounting. Well, that brings us to the end of this explainer. From the incredibly rigid legislation of the Corporations Act to the self-interested, wealth-maximizing maneuvering predicted by positive accounting theory, we've clearly seen that accounting is so much more than just crunching numbers. It's a highly strategic, dynamic system completely driven by human behavior and economic incentives. So the question you really have to ask yourself now is, are you just going to blindly follow the rules, or are you ready to use them to actually master the game of business? Thanks for joining class today.